The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for being with me today. It's a most exciting day, isn't it? How's the volume, folks? Would one of you kindly just type in the question box that you can all hear me all right? Yes, thank you, Keith. Keith, yes, I got your email. We'll have a session next week, shall we? I'll send you an email about it. That's great, thank you. So, yes, welcome everyone. Albert's with us. He's a tutorial guy, as is Keith. Carol's with us. We don't have many ladies, and I always like to say a special hello to them. So hello to you, Carol, and thank you for being with us. Dana's with us. George is with us, of course. Graham, he's a tutorial guy in New Zealand. Graham, I got your email. I'm going to make that recording for you this week, and I'll get it sent to you as soon as it's processed. And we can have a little talk next week as well. So that's great. Greg's with us. He's in Colorado Springs. He's a tutorial guy. Good to hear from you, Greg. And Hank down in the Hunter Valley. Jeff's with us. Charles with us from Vero Beach in Florida. Thank you to be with us. Martin's with us. The Murph is with us, of course. Wouldn't be a Daniel Code tutorial without him. Would he? Monty's with us. Nathan, yes, good. Grand to have you all. And Norbert, he's a tutorial guy up in Canada, up in the cold country up there. Peter Max with us. He's the short-term trading guru and tutorial guy. Sean's with us as well. Tom's with us. A couple of Toms with us and a few Mikes. Anyway, folks, let's get on with it. I mean, boy, what a day to be doing a tutorial and talking about markets. For those of you who don't know, there's been an enormous blow up on the stocks and options markets. And naturally, I'm going to tell you all about that today. But there are protesters on the streets of New York outside the New York Stock Exchange protesting what's happened, and Congress has decided that they're going to get involved as well. So I think there's lots more drama to come, and I'm always interested in that. Drama's great for futures traders. Sue's with us up in Cairns. Sue, lovely to have you with us, sweetie. I hope your trading's just as good as it has been. Wonderful to have you with us. Okay, so let's move on. We've got a whole lot to talk about, and let's see where we are here. Okay, so here we are. We're saying that, as you know, markets are rational, orderly, and sometimes predictable. And of course, this is one of those occasions. So let's get to the interesting stuff. The hypothesis is that all important market action is known and reflected in the charts, and that news is simply the media trying to explain to the great unwashed what has already happened. And news is an almost unlimited commodity. There's so many guys and gals in the news business and corporations, and my view is that as news capacity increases, the product must expand to fill that void. In other words, work expands to fill the available time, and I think that's true about a lot of things. But let's go and compare the news to the chart. So Wednesday's pullback in major equity markets was, for most people, a shot out of the blue. Bullish sentiment's just been enormous, and political and social drama was fast dissipating now that Mr. Trump's left us. They don't seem to have anything else to write about. But there's an unusually complicated reason attributed to Wednesday's big down day. So what this is all about, basically, if you're not aware of it, read Zero Hedge. They're a rather irreverent and some take a somewhat sarcastic look at markets, but they're very, very smart people, and they've been covering this issue for a while. So some time ago, there was a new platform introduced calling itself Robinhood. As you know, the idea of Robin Hood is that he robs the rich to give to the poor. Well, this Robin Hood's managed to, I think, rob the poor to give to the rich. But anyway, its whole basis was that it was free. You could trade stocks, options for free. Well, of course, the great unwashed out there, they've been brought up on the concept of everything being free, and they've flocked to it. And they've got a few cheerleaders, and you'll see as we roll along. But of course, nothing is free, and certainly nothing in this business is free. So the question is, how does Robin Hood fund itself? And the answer, extraordinary as it may be, is it sells its order book to some of the biggies in the industry. Citadel's one of them, probably the biggest financial player in the market. And they pay Robin Hood for their order flow. So what's the point of that? Do you think they're paying a whole lot of money to do nothing with that knowledge? I mean, it would seem Blind Freddy would say the benefit is either to piggyback on the retail orders are coming in, or to trade against them. To me, it's been almost inconceivable that the SEC and the other regulators could possibly allow this arrangement. But, the answer has always been the same over the years and years that I've talked about this, and that's regulatory capture. And the folks who work, some of them, not all of them, but a good proportion of the folks that work for the regulators finish up going to work for the big brokerages and the big hedge funds. And regulatory capture is just as prominent in this area as in all of the others. So I'm going to split this up a little bit. If it got a bit out of order for you folks, forgive me, because we started off, I want to talk to you about correlations, what they are and how you can benefit from them. And then this whole business with Robin Hood blew up in a big way. So part of this webinar is on correlations, and the rest of it is on the dramas of what's happening and what it means. So on correlations, they're usually directional, and they're usually in a linear manner. That is, they're unidirectional. So all of the US equities markets, Russell Dow, Nasdaq, S&P, and Germany's DAX are so highly correlated that you can take a signal in one and trade it in any of the others. So if we had a sell signal in the S&P and you wanted to be trading the Dow or the Nasdaq, you can take that sell signal in those markets so long as the trade is elected, by which we mean that the market moves to that point where the trade becomes live. And we publish that details under trade program is the link, and the Daniel Code website. Some of these correlations happen because there are similar forces working in the market, and you're going to see a whole lot of that with the dramas that have happened in the last couple of days in the market. Others of them are simply a function of their creation. So you'll see with a lot of the Forex pairs, they'll have one of the pairs on the same side of two different markets. So these market correlations are directional. They don't extend to quantum. In fact, nothing in the Daniel Code signals actually speaks to quantum. So let's see this. So what's happened is that Robin Hood has been a media sensation, and thousands of they're always described as new traders, as young people. I guess they're all sorts of people. That's what certainly happens. But they've been attracted to this platform because to them it's free. That is, they're not paying any commission. Of course, as I've already told you, Robin Hood's making its income by selling its trade flow, and the people who are paying for it, paying a lot of money for it, are obviously using it for some purpose which may or may not be nefarious. So now you had a guy called Dave Portnoy, and he's a real character. His real business seems to be sports betting, and he's got a corporation, very successful, that he sells for a lot of money. And he's one of the leaders of this push of the people who are on Robinhood. And his whole thesis is that markets always go up, so just buy, buy, buy. And that's been going on for a while. And what's brought it to the issue now is that since 2013, Zero Hedge has been publishing the list of the most shorted stocks. And shorting means that you've sold something. In stocks, it means you've sold something that you don't own. There are all sorts of restrictions on shorting stocks. For example, before you can short a stock, you've got to actually have borrowed it or leased it. You pay a fee to lease the stock, and then you short it. But it has the same repercussions that if you short that market and it goes up, you're losing money. And if it goes up a lot, you're using a lot of money. And at some stage, you're going to get a margin call or be closed out. So the huge number of new small traders have joined Robinhood. And got this idea from Portnoy, which is certainly working at the moment, although, I mean, it sounds so silly, you know it's going to end in disaster for a whole lot of people. But he's been pushing this idea that stocks only go up, ever go up, buy anything, whatever you like, just buy it. And they've focused on a number of stocks in this most shorted stocks list. One is called GameStop. It's a relatively small video leasing and selling company, which is not sort of the hottest flavor of the month, and that's why there's so much short interest in it. And that short interest has got bigger and bigger, and some of these companies that we're talking about on the most shorted list, the short interest, that's the stocks that have been sold. People have borrowed stocks to short with stocks. That tell you what you have to do. That short interest is sometimes 150% of the total market capital or more. And of course, big hedge funds, some of them are very, very short, the most shorted stocks list, particularly on this stock GameStop. But there's others. And what happened yesterday is at least two big name hedge funds, and I mean big name hedge funds, had to be bailed out. They were short this stock and other stocks on that most shorted list, and I call them the social media crowd, have managed to just push these prices up so high beyond no resemblance at all to fundamentals, no resemblance at all to eventual value. Just buy them because it's a short squeeze. It's a common method of creating a bit of a rally in a market, but this one has gone industrial scale. So at least two big names in the hedge fund business had to be bailed out yesterday, and I mean I'm talking $4, $5, $6 billion that's been disclosed. So goodness knows how much the real money is. So this is all very big time stuff. And what's happened is that as these particular names that they've picked up on are going up to ridiculous heights, so the shorts, excuse me, are taking a hiding, and they've had to sell some of their valuable long positions to finance their margin calls, and that's what's been attributed to the big sell-offs on Wednesday. And if you have a look across your charts, you'll see that all of that price action pretty well is encompassed in the Dow, the Nasdaq, and the S&P. The Russell 2000, which is the small cap stock index, it's been pretty much immune. It's going down, but it hasn't gone down. You don't see anything like it in the Russell that you see in the other indices. And the other indices, of course, is where the big players are. And that's why it's happened. And this mania has just gone mad everywhere. There's a very small mining company in Australia, a listed company in Australia. It's doubled its price. Of course, directors have no idea why, but quite simply, it's got the same listing name, the same listing code as GameStop. So the social media crowd have thought, let's be smart. If this is happening in the US, let's buy this stock in other markets. And they finished up not being aware at all of what they're buying. They don't know anything about markets. They've got this one idea. If you buy and hold, you buy and hold. Eventually, what? You break the market. Certainly you do enough damage. But how do they ever get their money back? These stocks are not going to stay at these prices forever. And in the meantime, Congress has started to take notice, led by the vociferous Alexandra Ocasio-Cortez, and going to be really interesting with Elizabeth Warren and others now in positions of considerable power as to what, if anything, they do about it. My guess is probably not as much as you think. I doubt very much if they even understand what they're talking about. And of course, due to regulatory capture, the regulators don't want to do anything to damage their mate. So the short story is that this damage was being done on Tuesday and Wednesday, and today, instantly, amazingly, apparently without any collusion, because that, of course, would be a civil and criminal offence, all of the big brokerages decided that they were going to restrict trading in those names. So for the whole of the trading day, the big boys have been able to trade, do what they like, but the Robin Hood crowd and others have had their access closed off. More than that, Robin Hood has drawn down hundreds of millions of its standby facilities. Obviously, massive liquidity problems there as well, and they've even gone so far as to start closing out positions of some of their traders without an order. And they've released a truly pathetic statement that they're a brokerage and they've got to pay margin. And we all knew that stuff, but they've taken it as a reason for them to start closing out some of their clients' positions, short positions. So the legal proceedings have started. The political proceedings, I think, are just getting started. I think there's a whole lot of representatives running around trying to find out what any of this means and what does short mean and what's the short squeeze. And it'll take them a little while to get up to speed, but they're in there and they're concerned because, boy, there's going to be some carnage. Someone's got to lose a whole lot more money than they've lost already. And interesting, last night I got onto CNBC very briefly. I don't watch any of this market commentary stuff. It's just it's amusing. It's about the most you can say of it. But here was a couple of the big brokers aggressively marketing their offer on margin loans. So obviously those boys think it's a good time to lend money to people who want to buy stocks. Anyway, by the by. So this is basically being touted as financial class warfare. And it's the little guys, as they style themselves, against the big guys. And by stopping trading, how all the major brokers could just at once have decided they were going to restrict trading in these names that were causing so much trouble to the hedgies is beyond belief. But most of what happens behind closed doors in this market and other markets is beyond belief if you only ever knew it all. And of course, the government's going to be the last people to ever find out. But essentially, God's on the side of the big battalions. They're the guys who make the rules. They're the guys who either own the exchanges or they're such massive players that they control the exchanges a whole lot. Keith's very upset about it. It's outrageous. Big money has attempted to manipulate markets for years. So my question is, why is it okay for them to manipulate markets, but when a bunch of small guys get together and take a shot at them, why is it not okay? Clearly the politicians, etc., etc. So that's basically the golden rule, isn't it, Keith? He who's got the gold makes the rules, and the big players in derivative stocks markets, in particular stocks and derivatives. This is an options issue as well. I mean, the call buying has been sensational, out of historically high, I should say, historically high. But essentially, these most shorted stocks are worth pennies, and eventually, somehow or other, they must return to their true value. And the just many small traders, I think 800 people joined one website yesterday, just in a day, to talk about, get the social buzz out of, we're taking on these guys, we're beating these guys, talk about what's happening and to be part of it. It's extraordinary. Let's see if this was such a huge surprise. So if it was a surprise, it wouldn't have appeared in the charts, but it did. So if you have a look at what the chart said about all this, this is S&P E-mini, of course, and you can see that we started off with the sell signals. 1, 2, 3, 4, 5 days ago, you had a absolutely classic TO3 setup. Next day, this was that first signal came on the Wednesday evening. Sale would reflect the Thursday order. Next day, the Thursday of last week, we actually got a blue line sell in the S&P, which, of course, we posted. Then we moved on to Monday evening with the big outside up bar there. We had another blue line sell, very, very unusual. But you can see how this market's just been tracking this 38.50 number, either on the high or the close for 1, 2, 3, 4, 5 days. And then this is, of course, what culminated all of it. On Tuesday evening, we had another TO3 sell in this market. And Wednesday, of course, it fell out of bed, and down it went. But look where it stopped. It went down, we can say exactly, if you like, to 3706.50, which was support from the Daniel Code retracement tool, for those of you who have it. Otherwise, you'll have to wait to see it on the charts, I guess. Okay, so and look where it closed on that blue line, 3735.25, just a handful of ticks away from it. So look what happened in the Russell. The same thing. We had a TO3 sell signal on Monday evening, posted for Tuesday's trading, and of course elected on Wednesday. But it's not dramatic, is it? Can you see the huge difference? I'll show you the Nasdaq and the Dow in a few moments, but you can see the Russell is a very, very subdued sell signal in there. Nothing exciting at all, really. Have a look at the Dow. Over 600 points down. Now, what we had there, we had a Wednesday evening last week, that's January the 20th. We had a TO3 sell signal, which we posted for action on Wednesday. The Wednesday evening action on Thursday, which was elected. And on Friday, if you've been trading a daily bar and had your stop at plus 2 ticks, you actually got stopped out, which is why I put on another TO3 sell signal for you on Tuesday evening, just to make sure that all of you had got the point that there was a high probability of this market giving us some drama to the downside. Same thing again. Look where it closed. Right on its Daniel code red line support. That's the 50% retracement of the minor swing. Just the low, remember, market recognition in the Daniel code can occur at the bar high low or the close. So this market's going down, so we expect to see that target recognition, as we call it, either at the low or the close. And you can see we didn't get it on the low, but look where the close was. That's almost perfect target recognition. Now, this is a market that went down over 600 points on the day. This was Wednesday, I'm talking about. Tuesday's PM signal, Tuesday's bar set up the new TO3 sell, so we posted on Tuesday evening for Wednesday's trading. But this is a market that went down more than 600 points. You'd have to call that dramatic. You'd have to call that unusually large. But yet, there's nothing unusual about the price action. In the midst of all of that supposed drama, this market said no drama at all. I'm just going down. I'll stop at the next Daniel code retracement support. And it did, just about perfectly. So here's the Nasdaq. It had a signal on Tuesday evening, which we posted for Wednesday's trading. TO3 sell signal. It also happened to be at a blue line. It didn't qualify as a blue line trade, but you can see some of the characteristics of the blue line trade are there in the target recognition of the blue line to within a handful of ticks. Pretty extraordinary stuff, isn't it? And of course, this is just the start of it. Look what happened in Germany's DAX. This is a correlated market. All of the US equity industries, Russell, Dow, Nasdaq, S&P, are so highly correlated, as I said, that a trade or a signal in one of those markets can be executed in any other of the markets, provided it is elected. But have a look. This is Germany's DAX, highly correlated directionally with US markets. They're the big boys in the world. But have a look. It's a relatively feeble down bar. Nothing too dramatic about it at all. So you can see all of that price action was locked into the Dow, the Nasdaq, and the S&P. So most of this stuff is at a website called Zero Hedge. As I said there, I've read their stuff for years. Some of it's very amusing. Much of it's very interesting. But they're pretty sharp cookies. And if you want to know about this, there's a number of different articles or threads that you can follow through what's been happening. But here's a summary that they put up today. Robinhood's drawn down on its credit lines with the banks. Citadel, who's the people who are getting the order flow, one of the people who gets the order flow from Robinhood, denies it influenced Robinhood to restrict stock trading. Of course, they have to deny that. That would be illegal. And eventually, Robinhood was forced to restart trading for the Friday session, and the stock's up, I think, 75% on its daily movement. Incredible. So, as I said, Robinhood users are starting to complain that their GME positions are being sold without their notice. Elon Musk, I don't know why that's of any relevance. Barstool, David Portnoy, he's in there having an argument with everyone, including .72 Steve Cohen, who's a very, very leading luminary in the trading world, and was at least reputed at some stage to be receiving the order flow from Robinhood as well as with Citadel. So there's some users started legal proceedings, a lot more coming. AOC is livid with Robinhood's decision, and Robinhood confirms users are having issues with equities, options, and crypto trading. Well, I mean, obviously. Interactive brokers put a heap of these markets into liquidation. That's today. Excuse me. Bit of the hay fever in the morning has struck. And Robinhood's restricted trading and all of those, etc., TD Ameritrade, on and on we go. But you can read all about that in Zero Hedge and no doubt other publications. So we've looked at that guy. He's got in there twice. Here's the Nasdaq, because I'm going backwards. That might be why I do, excuse me. Let's go forward and see what we've got that's a bit more new and interesting. So with your trading, and I'm talking about this issue of, do the charts know as does the news know? Well, remember, there was no news about this for Wednesday's trading when the market sold off in such a big way. There was an understanding of the business of Robinhood, the platform, and there was an understanding of the millennials, the social media type people buying these individual stocks, and the push that's going on in that was a Reddit forum that just buy, don't ever sell, don't ever sell. Well, I mean, they're going to find out how well that works eventually. A whole lot of them been put into liquidation already. So, but for your trading, start at the beginning. Start with your uptake for the week from the fourth seal. And this is very important. It's becoming more important because Frank DB, who runs the fourth seal for us, wrote the article that you've seen. It's simply headed 2021. It's under the articles tab at the Daniel Code website. And he's given you the forecast, his forecast, or the fourth seal forecast, I should say, for the year. Now, we did this last year in December 2019, which basically said no problems coming up in 2020. And Frank had the intestinal fortitude that even when we had the big February sell-off last year, in the middle of it all, he was saying, this is just a correction. I expect new highs in 2021. But in his weekly commentary, this is published every Monday, he's updating what the market's doing compared to the forecast. So in here he says, longer term, we are on track for the all-time high in June. Now, DC signal will guide us. That's the important part. Make sure you trade the market, not the forecast. But then he finishes, for now, we take into account we could see a correction here, which is exactly what happened. So if you were subscribed to the fourth seal, the S&P section of it, at least you were aware of the possibility of a correction coming this week. And the charts that the fourth seal runs off are published in that commentary as well. You can see that at the Daniel Code website. So what was that probability of a correction here if we look at the 6-day chart? Well, have a look at it. This is the Daniel Code 6-day chart. That means every single bar actually encompasses 6 days, 6 trading days. And you can see that the current bar, it's not over yet. It goes until the 2nd of February, plus or minus 1 day. So we could see continual action on this issue in Friday's trading, and again likely on Monday's trading. That gives the big boys a chance to try and sort it all out, I guess. But as you know, the big boys do their own thing, and the rest of the world can only either watch or be amazed, or both. Those of you who saw the film The Big Short or read the book when Dr. Michael Berry forecast the mortgage crash in 2007-2009 will remember that the companies that issue the credit ratings, Moody, S&P, etc., were equally compromised, and same thing with regulatory capture. They wouldn't downgrade the ratings on the mortgages, even though they were all falling over massively, but eventually when they'd managed to sell off their own book that was the wrong way, then of course they'd start to do the ratings correctly for that issue. And it's the same thing everywhere. The big boys run the business. You've got to remember that. And they don't care what damage is done to the small traders, what's done to the individual traders. And it takes something pretty massive to get the regulators to actually get off their tails and do something. And this might well be an issue, but have a look on the probabilities of a correction this week. You had an 89 cycle, a 74 cycle, a 59 cycle, a 50 cycle, a 44 cycle, all based on the 6-day charts from various swing highs, and 1, 2, 3, 4, 5 major Daniel Code time cycles expiring this week that ends on the 2nd of February. So there was a high probability there. And remember, 2 of these time cycles came on the day before, or the 6-day period before. Well, the 6-day cycle for the previous period, that's actually given you so far the closing high of that whole rally. So these signals, time signals, are valid to plus or minus 1 period. And that happens because where they start from can either be a swing high, swing low, or a closing high, closing low. And very often that difference between the swing high, the closing high, the swing low, and the closing low will happen on a 1-period adjustment. You can only make that adjustment plus or minus 1 period. So the 80 cycle and the 74 cycle that expired on the previous 6-day period are entirely valid, not only for themselves but also for this current period we're in. So let's move that on a little bit and have a look what happens on the daily chart. This is the S&P E-mini, and you can see that for Wednesday we had 2 of the Daniel Code time cycles there in action. The first one was 70. And that took us to Wednesday. It expired on Wednesday, plus or minus 1 period. Don't forget that. And that came from a previous perigee. And then the next one that gave us a 59 cycle the day before for Tuesday, and also for Friday, the 62 cycle bites on Friday. So it's bracketed this big down day. And Friday, of course, is a probable full, well, not probable, it's a certainty. It's a full moon. Whether you can see it or not is another question. But your weekly time cycles, your daily time cycles were all cooperating to indicate this present time period we're in, including with the daily chart getting us right to the day of the high of the rally. So I put on the website on Wednesday that volatility has exploded in these markets. So watch your stops. Ensure they're within your risk parameters. When we get these very, very big bars, your risk parameter gets to be seriously at risk. You should never take more than 1.5 times the average daily range. Twice the average daily range is a complete and utter maximum. And that's because unless you try to keep your risk on entry roughly, very roughly, equal, you will destroy the sequencing part of the trading program that relies on the risk on entry being roughly commensurate and equal for all markets. So if you didn't have a stop on yesterday's position, 1,450 approximately, that's about 1.5 times ATR for the S&P, which will now be expanding very rapidly. But that at the blue line that it went through and closed on was a pretty good place to have your stop if you were protecting profit. Alternately, what we do when we get these massive super bars is you can put a trailing stop on equal to one and a half, but no more than 2 times ATR. It's pretty generous, and it's a way to protect your position. Okay, so here's the correlations now. I guess you're all going to go to Zero Hedge. There's a number of posts there which lead you in this whole sequence of what's happening, including the latest saying that they're protest starting outside the New York Stock Exchange. Wonderful stuff, isn't it? A whole lot of people who have no idea what they're doing are now making an argument that they should never be shut out of market, and that's a good argument. The opposition argument is for their own good. There should be restrictions on trading with some of this nonsense stuff that's been going on. So, U.S. equities, all of them, Dow, S&P, Russell, Nasdaq, and Germany DAX, they are also directionally correlated that a Daniel code signal in one can be executed in any other so long as the signal is elected. US dollar and COMEX gold are often inversely correlated. And I've actually wrote an article about that quite a number of years ago now, that inverse correlation, gold up, dollar down, dollar up, gold down, that comes and it goes, and it stays for long periods. And when it breaks down, historically, and I think I've gone back to the 1920s, to test that proposition, when the inverse correlation breaks down, it's almost always in favor of gold. And you're going to see that in another chart in a few minutes. So for the metals, COMEX gold, COMEX silver, and the Huey index are also highly correlated directionally, that a trade in one can be executed in any other, provided the trade is elected. Now, the Huey is actually an index. It's an index of the 25 biggest unhedged gold miners, and it's a proxy for either COMEX gold or silver, or a proxy for both, in fact. Now, we can't trade the Huey. It's an index. You can trade it with options if you're an options trader, but you can't trade it with futures, which is our particular poison. But you can take a signal on the Huey and you can execute it in either gold or silver. That's because the correlation, directional correlation, is so intense. Forex has direct correlations as well, and they can be utilized in your trading plan. So if you have, for example, I'll give you an example, I think on the next page. If you have Aussie USD as a trade you want to take, and you want to increase your leverage, you can take the appropriate trade in the Euro USD or the Euro Aussie, if you like. And that's a way of increasing your leverage without increasing your direct exposure to any one market. The Aussie dollar, for those of you who are amazed at how strong it's been, it's very highly correlated with iron ore prices, which are quoted on the Singapore exchange. And iron ore prices are near record highs, been very, very strong. And of course, that's what's dragging the New Zealand dollar with it. Australia's the biggest trading partner for New Zealand, so they need to keep their currency in a pretty much fixed relationship with the Australian dollar. So the power of the Aussie dollar through the iron ore prices at present is what's been strengthening, showing a lot of strength in the New Zealand dollar market as well. So here's our occasional inverse correction. Let me see what we've got here. Toddy's joined us. Good to have you with us, mate. Let's have a look. We've got a few latecomers here. Yeah, I think I've got most of them. Nathan's with us. Milton's with us. We know Murph. Mac Cutchins is with us. Mac, haven't heard from you for a while. I hope you're recovered, mate. I hope you're feeling good. Take care, my friend. Mac's had a few heart issues. John's with us. Jim's with us. Mainly all tutorial guys, aren't you? A lot of them. Wonderful to have you with us. Great. Deborah's with us. Deborah Linden. I don't know Deborah Linden, but lovely to have you with us, Deborah. We're always excited to have more ladies join us. We don't have many, and of course, we treasure them. Lovely to have you with us. Hope you're enjoying it. Okay, so here's this occasional inverse correlation with gold and the US dollar. The inverse correlation, as you can see there, is gold down, dollar up, dollar down, gold up. And you can see right here where it broke away from this inversion. This market rallied up, right up into many, many months after the high, the commensurate high in the DX was way back here. So this correlation probably started to break down soon after this big bar. And as I've said, when the correlation breaks down, the inverse correlation, it usually means that gold is going to get stronger. And those of you who follow the Daniel Code webinars will remember about that time I showed you a graph of gold with the Daniel Code black line on it, the 89% retracement. And I said if you get a daily close above that number, this market's going to go much higher, which of course it did. So that's the interesting stuff for you folks. I often say I don't trade stocks or options. They're far too dangerous for me and open to all sorts of manipulation. Futures, on the other hand, are relatively safe and sometimes predictable. That's why I love trading futures and Forex. And what's been going on, there's just a whole lot of skullduggery in all of that. And it's going to be really fascinating how it rolls out. So I do suggest to you that you read Zero Hedge. If nothing else, it will certainly give you some entertainment. Okay, that's pretty much us for today, folks. A whole lot of news for you to catch up on. If you want to be a super trader and learn to do all the things I've shown you today, understanding time and price in trading markets, able to create all of those studies that I've shown you, you should be thinking of doing a Daniel Code tutorial. If you are interested in that, please email me, jneedham@thedanielcode.com, and I'll be happy to send you some printed material and look forward to talking to you about your trading aspirations. For those of you folks who are subscribed to our Daniel Code Pro series, this Keith, not a comment coming here. Yeah, hi Mac, I do hope you're feeling better, mate. This is Keith again. I can't believe I actually agree with AOC or she with me. First time ever. Good on you, Murph. Glad you're enjoying it, mate. So, folks, don't forget if you're subscribed to the website Pro, that's the $249 a month subscription. You're entitled to 2 free markets from the 6S signals as well. So do let Terry know which markets you want, and he'll be happy to turn you on and get that enabled for you. Okay, so that's us for the day, folks. Remember, the business of trading futures and Forex is not to be right. The business of trading is making money. For those of you who haven't already had a free trial, please go ahead, click on the link at the website. Any problems with your access, contact Terry at support@thedanielcode.com. If you've already had a free trial, the website will remember it. Probably won't let you use that moniker again, but Terry can sort that out for you straight away. And please use that. Okay. So that's us for today, folks. It's a beautiful, beautiful day at the Gold Coast in beautiful Queensland. Sun is shining. Pacific Ocean is a beautiful, beautiful blue. And it's short sleeve weather here, of course. It pretty much always is. Thank you, Hank. Glad you enjoyed it. And Keith. So enjoy your weekend, folks. Keep a close eye on the drama. There's more to come. Has to be. Maybe much more to come. All right. Remember, please, folks, that futures are risky. I ask you to read our risk disclaimer and risk disclosure statement and take it seriously. If you don't know how to trade, you are going to lose your money very, very quickly. I do implore all of you, do not risk real money trading until you are confident you know what you're doing. And if you'd like to learn, send me an email, jneedham@thedanielcode.com, jneedham@thedanielcode.com. Down the Hunter Valley, Hank says, rainy and overcast. You should be at the Gold Coast, mate. And I will be more than happy to teach you everything. Big statement, isn't it? I'll happily teach you everything you need to know about trading futures. That's it for now, folks. I'll look forward to talking with you all again next week. And thank you for being with us today. Bye-bye for now.